Could mortgage rates break out even higher after last week's inflation report? We saw rates come up, and now, as of the beginning of this week, we're seeing quotes in the low 7% range. So I'm going to explain exactly what's going on here in a second. If you get some value out of this, make sure to subscribe to the channel, click on the bell for notifications, and if you want to talk about how this mortgage rate volatility is affecting your real estate plans, you can schedule a call with our amazing team with the link in the comments. So we got this inflation report from the federal government the end of last week. We saw that inflation was up 0.3% in January and came in at a total of 3.1% for January. We know the Fed's target is 2%. The expectations were that we were going to see a 0.2% increase and a 2.9% target for the month of January. The month of December, we saw inflation coming in at 3.4%. And if you break this down even further, shelter, which is housing, rentals, buying properties, all the stuff that we talk about here, that was up 0.6% and came in at 6% over the last 12 months. And this is higher than where people wanted to see this data or where they were expecting to see this data. And just so you understand what the CPI is, it's the Consumer Price Index, and that's what the cost of goods are for the day-to-day consumer. So these were higher than expected. And as a result, we saw mortgage rates jump up a little bit. And we've got a Fed meeting coming up at the end of February. We're going to see what happens in March. This is not what the Fed necessarily wanted and what a lot of economists expected. However, inflation is moving in the right direction. The chief economist over at Bright came out and said this. Bright is the MLS that we use that covers D.C., Virginia, Maryland, parts of New Jersey, Philadelphia, and the greater Philadelphia area. So it's the lower rate that we're seeing inflation doesn't mean things are costing less. Even though inflation is down from where it was last year, it doesn't mean the price of goods are actually falling. And instead, it's that they're just rising more slowly, which is a really insightful way to look at all this. So the reaction from the market was that rates went up, mortgage rates went up. We saw that happen and continue to happen last week and this week. So what does all this mean? So here's what I know, that you really want to get clear on what your goals are as a seller or a buyer. Rates are always going to be jumping around based on these reports that come out. Mortgage rates are very sensitive to Fed rate hikes, to inflation data, to jobs reports. There's a couple pieces of data that come out each month, and you see rates move based on the expectation around that data and where the data actually comes in. So you're going to see this happen all the time. And what you want to ask yourself is, do you really want to wait to buy a home or wait to sell a home if rates go up or down a little bit? And is waiting going to solve your problem? Because ultimately, when you make a decision to buy or sell real estate, there's a reason behind it. And it's not because it's a great time to buy or it's a great time to sell. Very rarely do we see people time the market and win. It just doesn't happen. When you try to outthink the market will outmaneuver you. It's very, very difficult to do. And when you see data like this come out, it's going to cause the market to react. And then typically in a week or two, things settle down. That's not always the case. This is just what's happened throughout history. And what you don't want to do is, if you've got a plan because you're moving for a certain reason, you don't want to change that plan because of mortgage rates. And that goes for sellers and for buyers. So what I'd be looking at if I'm a buyer right now, what monthly payment makes sense for me? And can I afford this home based on a monthly payment? That's independent of rates. Your monthly payment could be $3,500 a month. It could be $2,500 a month. It could be $4,100 a month. It doesn't matter. Whatever payment's going to fit your budget, that's what you should be focusing on as a buyer. And as a seller, you're probably going to be going and buying something. You want to ask yourself the same question. Where's the payment that makes sense for me? And how can I target homes at that monthly payment? So there's a lot of great resources to do that. You can use an online mortgage calculator. You can talk to your local lender, the lender that you're using. They could give you a couple different models of what it's going to cost based on the percentage where mortgage rates are coming in that particular day. In a past episode, we showed a grid from one of our preferred lenders where it shows you how your payment fluctuates based on the current rate in the market. That's really what you want to be looking at, whether you're a seller or a buyer, because this news is always going to come out. Rates are going to go up, they're going to come down. It's just like stocks. Stocks are up, stocks are down. It's a function of the market. And while rates could stay up in the 7% range, a lot of people are still expecting they're going to settle back in closer to 6 and maybe high 5s by the end of the year. Those predictions haven't changed, and a lot of that's going to depend on where this data continues to come in and what the Fed decides to do at their upcoming meetings. I would not be expecting a rate cut at the next couple of meetings. It looks like it's going to be probably spring after March at the earliest when you're going to see a Federal Reserve rate decline or a cut instead of a rate hike, which is what we've been used to. So I would be looking at where rates are right now. We can control the rates. We can control how we search for homes. Now, the positive is we're not seeing demand slow down for sellers. That's not going away at all. And if you're a buyer, maybe you want to look at, and I'm not sure if any of these are going to be for you if you're a buyer, maybe you want to look at an adjustable rate loan, buying down your rate with points, putting more money down. Look how you can finagle the numbers or go with a different loan product that can get you the payment that you want if you find a house that you want, and then renegotiate or refinance the rate later if you're not afraid of rates coming back down. These are the options that are out there, and I'm not sure if any of them are going to be for you. What I'm clear on is it makes sense to talk to someone that can help you navigate all these questions. So if you got questions, you want to know more, you can reach out to our team with the link in the comments here. Rates could go higher. That's absolutely true. They could stay the same. They could go lower. Focus on your payment.